Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain, and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Well, hey, Ray, welcome back to the show.
Thank you. It's a pleasure to be here.
Hey, well, it's always fun to talk to you, and it's been a while, and so I'm excited to get back together and have a conversation. And it looks like we're back on the topic of energy transfer partners, or energy transfer LP, I should say. And you wrote an article recently entitled "Energy Transfer versus MLP Peers: Value Stock or Value Trap." Do you mind, for those of our listeners who have yet to read the article, do you mind sharing briefly kind of the thesis and the big idea behind the article and your views on energy transfer?
Sure, Brian. I try to write an article a quarter about energy transfer, and rather than just kind of recite the quarterly the quarterly results and so forth, I try to add to each one of them something that I think would be of interest to investors or prospective investors. And so in this most recent article, I wanted to look at energy transfer as a function of how does the valuation compare with energy transfer versus similarly situated peers. And part of the underlying reason for that is midstream MLPs have had a rough go of it over the last several months. Energy transfer has not been spared. As a matter of fact, it's probably been punished as bad or worse. And so I wanted to look to see how energy transfer stacks up versus some specific peers that I picked, but they're similarly situated, and determine, well, what's going on? Is it better? Is it worth? Because when I went into it, I really didn't know the answers. And then as I got into researching the article, then it became clear. I followed up then with a little bit of analysis. And indeed, I even was fortunate enough to be able to talk to a contact that I have at Energy Transfer and chat with them a little bit about their thoughts. And maybe we can share some of that.
Sure. Well, so let's go ahead and start with the beginning. Like, what peers did you select for your comparison?
There are 4 peers that I picked. Now, there certainly could be a number of other ones, but I picked peers that, one, also are limited partnerships, no C Corps. I also wanted to pick peers that are what I'm calling single entity, meaning that there's no GP or LP, general partner, limited partner, and IDRs. Recently, Energy Transfer rolled up and became a single entity MLP, as are these other 4. And then, in addition, I wanted to make sure that the peers that were selected were larger in terms of just simple market cap. And so with that, MPLX was picked, which is kind of an offshoot of Marathon, Enterprise Product Partners, Magellan Midstream Partners, and Plains All American Pipeline. And those were the ones that were selected.
Okay, so MPLX, Enterprise Product Partners, Magellan Partners, and what was the last one?
Plains All America Pipeline Partners.
Great. So how do they stack up?
Well, what was quite interesting about this is almost across the board, the valuation metrics are such that energy transfer is low on the totem pole. And I was a little surprised with that, not shocked. Because
meaning the valuation is low, or the metrics and quality of the company are low?
The valuation is low based on, let me back up a little bit. The valuation metrics I used, and there were several, there were 4 different ones, they're all based on multiples of something. And so when you look at the valuation, if a company is valued, say, arguably at 10x something, and then the 7x or 6x, well, that would indicate that the second company is undervalued or a lower value than the first.
Right.
And so in the case of energy transfer, almost categorically, it was low versus the other 4 in terms of valuation multiples.
Interesting.
Yes, very interesting, because earlier in the article I pointed out that if you look at their last quarter's results, and frankly, as well as the quarter before that, their results are outstanding. The results are actually quite good in terms of cash generation, working towards reducing leverage, improving the balance sheet, and so on and so forth. And then when you look at the valuation multiples, what Mr. Market is saying, we don't care. It doesn't matter.
So why do you think that is? I mean, is it what intangible is going on? Is it a dislike for Kelsey? Was Kelsey Warren, I believe, is the CEO? What do you think is going on?
Well, that's a great question, and I have several thoughts after going through this and having discussions and so forth, some of which, Frank, has also been ratified by the readers. This article has a lot of comments.
Yeah, it does.
But if I were to sum up, I think what the street is looking for is they're saying to Energy Transfer's management, one is you've got to get the leverage down. And leverage is considered kind of net debt to EBITDA. And so Energy Transfer is higher levered than some of the other ones. They're talking about getting it down that would be well in the range of these other companies, but it hasn't been done yet. And so I think that's one of the things the street is saying. Two is, and this was I'll say ratified, if you will, by my resource at Energy Transfer. The street was unhappy that Energy Transfer is looking to spend $5 billion in growth capex in 2019. They want to see the company dial it back a little bit. Energy Transfer has been on an enormous growth capital surge. I think it had got as high as $11 billion and in 2017-18. And I think they were looking, meaning the street was looking for not something like 5, but 3. And so I think that it's been bid down somewhat because they're saying, well, look, you guys at Energy Transfer, you're not getting it. You're still into this go-go growth mode. And in defense of management, their response is, no, these are high return, very solid projects. They're, if you will, effectively, there's commitments by producer shippers ahead of time and so forth. But again, the street is, I think, pushing back a bit on that. The third thing, I think, is returns. And that's something that, so again, it surprised me a little bit, but the 4 peers that I selected, and certainly with it could be argued, but I would say are probably looking towards more the best of breed, at least of the midstream MLP companies. And if you look at their return on invested capital, which granted, there's a number of ways to run this calculation. I simply ran it in a very simple manner, but consistently. Energy Transfer is low. And so I think there's an argument that the street is making that you need to get your returns up. And the same way the leverage needs to go down, returns need to go up. And it's a show me, don't tell me kind of an attitude. And so I think that's in large measure why ET is not getting the valuation multiples of some of its peers. Because frankly, Brian, you look at the rest of it and you say, okay, their leverage is high, but credit rating, it's investment grade, and their distributable cash flow coverage ratio, that's fine. The distribution yield is high, so it's not that they're shorting the investor. I think it's and again, it's on a table in the article. I think that critique is the return on invested capital, leverage, and the street saying, man, you really need to dial back some of this spending, growth spending, and I think until that all settles out, they may not change much.
So it sounds obvious. Obviously, there seems to be a disconnect between management thinking what's best for the company and Wall Street thinking what's best for the company. Whereas not uncommon. Wall Street likes predictability, it likes as much certainty about the future as possible, and is fearful of unpredictability, especially when it comes to debt. So it sounds like leadership of Energy Transfer is thinking, yeah, we realize we've got this high debt we could be paying off, but we have such a great investment opportunities in front of us. We don't want to ignore those because they think that's a more compelling use of capital than paying down their debt. But Wall Street says, hey, that's creating more uncertainty because we're just afraid. There's just, in the energy business, there's all kinds of ups and downs and swings and things that can happen, and we don't want the risk of that leverage, and they're punishing them for it. That sounds basically like what's going on. Is that sounds like basically how you're seeing it as well?
I think that's a fair assessment, and the nuance would be is that Kelsey Warren is if not the major stockholder in Energy Transfer in terms of who owns a chunk of the company. His fortune is largely tied up in Energy Transfer. He is a risk taker. He's aggressive. There have been a number of actions that Energy Transfer's taken that have really pushed them to the brink of serious litigation that could have actually toppled the company. They've struggled through financial issues when the price of energy crashed. MLPs were unable to raise capital through secondary debt offerings. He struggled with each of these, each time figuring a way out. Okay, so to the positive, but at the same time, I think that maybe Kelsey has been a little more surprised at the veracity of maybe environmentalists trying to knock back and delay his projects or Energy Transfer's projects. The street indicating what they're looking for versus maybe as a independent, if you're going to say kind of a wildcatter, how you would do things. And so there's some dynamic tension that I'm hopeful is going to reach an equilibrium, because, for instance, I think Energy Transfer's management is well on board of saying, yes, our leverage needs to come down, it needs to come down considerably, and we're going to do it. And as an investor, I can say I see a clear path for them to meet their objectives. Some of the other things, that's where you get into, again, the street is looking for dial back the growth. Energy Transfer's management is insisting, yeah, but these are great projects. We can't walk away from them. They have tremendous returns. The street might counter and say, yeah, but your return on invested capital is low. So you can kind of see the backstory here.
Sure.
And I think it needs to be, it will reach an equilibrium at some point, and I'm actually optimistic that it will reach a good point, because I think Energy Transfer's management gets it. It's just the nature is that it tends to be a very independent and very aggressive company, and the street tends to sometimes penalize that.
Is there a history of Energy Transfer? They're saying, hey, there's great investment opportunities with great return potential, but as you mentioned, I guess recently or historically, the return on invested capital has been low. So I guess Energy Transfer is trying to say, hey, it's different this time, and Wall Street's like, I don't believe you. It's basically kind of how that's going down.
I think that could be a factor, and all of these are, again, they're all, the discussion is, quote, soft. So, right, you can't prove much, but, if you were to look at Dakota Access and the Mariner East franchise up in the Northeast, and even Bayou Bridge, which is in Louisiana, where it's supposed to be favorable, I think that, the projects when they were originally being scoped may have had a return or an expectation of X, but because of litigation, delays, just all kinds of problems because of trying to build, if you will, energy infrastructure in maybe some of those returns were knocked back a little bit, right, and the street is not necessarily convinced. Brian, a good pipeline company would seek, if you will, committed projects, meaning there's commitment before the project is even started, that would yield IRRs in the vicinity of 15%. If we look at that list, and again, my calculations for ROIC was just down and dirty, but Magellan is there, Marathon or MPLX is pretty close, Enterprise is not far behind, and then you got Energy Transfer, which, again, to be fair, they still have a fair amount of capital that's tied up and not getting any return. And that's another factor. And that's something else I think the street is alluding to is you will, if you were to say, okay, we have, and pick whatever number you want, we have $10 billion of capital that we're going to spend. Okay, well, if a big slug of that has been spent, but the project isn't yet complete and ramped up, then that's going to under-earn even if the investment return is supposed to be greater. And I think that's part of what Energy Transfer is also dealing with. They have the Mariner East franchise, some of the Bayou Bridge money, maybe Revolution. I'm not sure if that's fully subscribed. But you have all this capital that's backed up and not necessarily returning full rates. Gotcha. And that's another issue. It's all, I think, part of the same narrative.
Yeah, well, that makes sense. If they have, they're more highly levered than competitors, and so obviously they've got greater debt, they've got to service and got to pay off, and then in addition they've got a lot of capital that's invested but not returning yet. There's a number of factors there that make sense why they'd be penalized against their peers. So in a sense, I guess it sounds like there's maybe good reason for Wall Street to be discounting Energy Transfer just because compared to peers, there appears to be greater risk with this company, but as it goes, because of lower valuation, there's the chance for greater returns because it's valued lower, assuming those risks don't manifest themselves in a negative way. And obviously, for someone who's a shareholder like yourself and others, your hope and expectation is that Energy Transfer with Kelsey Warren and management will be able to navigate the waters well and work through these fears that Wall Street has, and then anyone who's willing to join the stock at these levels will hopefully be able to benefit more so than you would if you're going to go with an MPLX or some of the other companies you mentioned.
Absolutely, because I'll kind of sum that up and then offer maybe a bit of an analogy. But you can look at the fundamentals of a company and say, well, if you pick the A student, if you will, there's not much room for improvement. If you take a student with a C plus, well, then there is room for improvement, and the street tends to, in many cases, reward the C student who does better than the A student who's just plugging in A's all the time. And the maybe another, if you will, a loose analogy that I think represents Energy Transfer is if you had two golfers, and let's say they even come up with roughly the same score at the end, but one golfer hits the ball a mile long, but half the time it's in the rough or in the sand, and he's having to make tremendous recovery shots in order to secure par. And then you had another golfer who basically just hits it in the fairway, and he doesn't hit it as far, but he keeps the ball in the fairway, and there's not really a whole lot of mighty recovery shots required. Most people would say if I were going to put my money on something, I'll put it on the guy that keeps the ball in the fairway and just makes his par without much fanfare. Energy Transfer is not that golfer, or at least has not been in the past.
Right.
Now, again, I think, and the reason I'm still hopeful is they've worked through some just horrendous circumstances, some of which was out of their control, some of which arguably was within their control. But I think the management team gets it. It's just a matter of how long it'll take to kind of get things sorted out and reach what I called equilibrium with the street and their expectations.
So going forward, so I'm thinking about moving forward with this because I feel like, at least from my view, as I'll consider myself largely an outsider to energy transfer, the thesis you're explaining makes sense. So I guess moving forward as an investor, obviously you're putting a lot of faith in management to be able to execute on what we're describing. Yes.
Yes,
And
it's a difference.
right. And okay, so, and you mentioned you've spoken to someone within the company. Is there anything additional you want to share from that conversation, or maybe you've already shared that in some of the things we've already talked about?
We've largely covered it.
Okay.
Again, the conversation wasn't, because part of the conversation was I offered what I thought needed to be done, which is somewhat aligned with the street, in just that, now would be a time to try to maybe take some of the uncertainty and reduce the beta, and just kind of like, pipelines at core are boring. Okay. I mean, I was a pipeliner for many years, and it's just kind of, you put something in one end, it comes out the other. Operational excellence is important. There's not a whole lot of drama. Okay. Energy transfer seems like has nothing but drama. And I think that maybe part of the message is, just operate a pipeline for a while. Right. Good operational results, generate strong cash flow, shore up the balance sheet, and I think things will be fine. And that was part of the discussion. And again, I think that's registering. It's just a function of, then you get what we got there's always we got this project and it's really good still. It's going to get great returns. Well, that's kind of a throwback to saying that has to be balanced.
Mm-hmm. Right. Well, and it's like maybe one of those things where maybe management got a blind spot they're not willing to acknowledge, keep saying, well, but it's different this time, it's different this time in terms of this new project that has great potential, then continues to get backlogged or litigated or having some kind of an issue. And again, Wall Street's just saying, well, we're kind of tired of the story, it's time to prove it. And that's where, the advice you're giving makes a lot of sense. It's like, let's just execute for a while, lay low, run a pipeline business. I know a big factor for MLPs, obviously, is contracts and things. Is how is Energy Transfer in that regard? Are they with the assets they do have online? Are they pretty well contracted and pretty secure and steady cash flow and things?
I think so. Yes,
okay.
The Energy Transfer they don't have any problem with contract management. The subscription for their major projects, once they finally got going, is strong. They have a lot of what is called fee pipeline revenue, which means it's just straight, they take money in. A lot of it's take or pay, which means the subscriber pays for the capacity, whether they use it or not. That's all fine. Mm-hmm. If I were to offer another model, a much, much bigger company, but one that I'm quite familiar with. Royal Dutch Shell, for a long time, also suffered from low multiples and concerns from the street over having to do with expenditures and returns. And more recently, their relatively new CEO, Ben Burden, Mr. Van Burden has said, we are going to make a world-class investment case for this company. We're going to reduce expenses. We're going to show a lot more discipline with our capital. We're going to get our balance sheet squared away, and we're going to focus on certain core parts of the business. And otherwise, it might be, it's not. We may not keep it. And they've divested a huge amount of assets. I think that's a good blueprint for Energy Transfer, though it's a different company and obviously much, much smaller. But I think that's what would really help them.
That makes sense. Again, based upon what you shared, and obviously you spent a tremendous amount of time and following the company and researching the company and writing about the company, and it based upon our discussions here, it sounds like that would be really that's what's needed to happen. And so, so in summary, Energy Transfer compared to peers has a lower multiple almost across the board. And we say largely because they're over levered and not addressing that like Wall Street wants. Their return on invested capital is not what Wall Street likes, and there's kind of an inherent history of risk taking and kind of trouble in different areas. And Wall Street's just discounting that until Energy Transfer can prove they're willing to take these issues seriously and create a little more safety and a little more stability.
Yeah, a little more safety and environmental performance.
Right.
Maybe not as aggressive spending capital.
Right.
And I think when these all come together, and I'm optimistic they will, this will earn, or the Energy Transfer will earn multiples that are comparable to peers. And if you look at those numbers, I mean, boy, you'd be getting a higher distribution yield than peers today, and that distribution is safe. And at the same time, maybe considerably more upside in terms of capital appreciation. I think it's a risk well taken.
And again, and your confidence in that they will make these, we'll call them the right decisions to make the company maybe more shareholder friendly. I guess based upon just what you've seen historically and maybe conversations internally in the company, have given you confidence that the company recognizes these things and is taking them seriously and will continue to do so. Is that fair?
That's a fair statement. I guess I would put it, I think there's a good probability that management will get this sorted out. I never want to say, high confidence. I think it's all part of the due diligence process for every investor. But my view is I think the probabilities are higher than not that management will get this sorted out. They'll listen to what the street says, and they'll get the what's arguably the biggest of these 5 companies that are in the article on the right track, and will earn multiples, particularly of DCF and operating cash flow, that would be comparable to peers, and it'd be a bunch of money.
Absolutely. Well, hey, Ray, as always, it's a great time to talk, great interview, and I appreciate the way I think you always exemplify excellence as an investor in terms of the diligence you put into your work and the way you communicate. And I just appreciate your work on Seeking Alpha and your time here in the interview, and wish you the best.
Thank you. It's always a pleasure talking to you too, Brian. Take care.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.